I just want to say a few brief things. I'm seeing three trends play out in this transition to a low-carbon economy through investing. The first trend I'm seeing, and I'm curious if the panelists concur, is that we're kind of moving from the original approaches of socially responsible investing, from the more negative perspectives, to the idea that through a positive framework, we can drive both shareholder benefit and societal benefit at the same time. So that's particularly exciting to see that trend play out, because then everyone wins. The second trend I'm seeing is record levels of awareness in the need to invest with sustainability factors in mind. And then the third thing I'm seeing certainly is that we need to look at the entire system, and not only the system, but what data do we really need, and how can we improve that information. So with those three trends playing out, we actually have something of a cross-section of the system here today. We have a fund manager, in effect, Ira from DBL, and we have an asset owner, in effect. We have Deborah from the state of Connecticut. Then we have the most important advocate, I think, for a change and driving more responsible investment in the PRI, and we have Sonal here to talk about their work. So with that brief introduction, I'd like to turn it over to each of the panelists to introduce themselves and the work that they do. So, Ira.
Great. Well, good morning. It's great to be here. My partner was actually here last week at the sustainability event, so it's great to do the back-to-back with you all. So I'm the co-founder and managing partner at DBL Partners. We founded the firm on the belief that actually it was that you could actually achieve market returns, but better than market returns, by combining what we call the double bottom line. So first bottom line, the financial side. The second bottom line is some form of environmental, social, diversity, or governance perspective, and weaving it into every investment we do. We have been in venture capitalists for, this is my 20th year as a VC, and we come from the perspective of professional investors focused on impact, as opposed to, I think, some of the early days of well-intentioned people trying to learn how to be investors. And that's a radical change, I think, in the venture community and in the impact community in terms of who is focused on this now. We have invested across the board. We have, of course, an energy focus. I'm the early investor and still on the board of Tesla, where I've been on the board for now coming on a decade. My partner Nancy is the early investor in Solar City. We have investments in storage, wind, energy efficiency. We just made our first solar investment focused on Africa. So we have across the board on the energy side. We also believe that impact can live and breathe in any company. And so we have a whole range of other companies, including ag. And then, of course, on the IT side, where we build a bridge and actively work with our portfolio and entrepreneurs to essentially enable them to realize some of the aspirations around impact, where we proactively and with intentionality work with the entrepreneurs to create the kind of vision that they have in their companies around the second bottom line.
Great.
I'm Deborah Spalding. I'm the Chief Investment Officer for the state of Connecticut. I work in the Treasurer's Office. We manage just under $30 billion in largely pension assets for state employees and teachers and municipal employees, as well as a variety of plans and trusts. We invest across all asset classes. All of our assets are managed externally, so I spend a lot of my time focused on asset allocation, manager due diligence, and selection. We do have a commitment to ESG. We have a very robust policy unit. We don't tend to use the word SRI. We use the term ESG, and we also have the mandate in Connecticut state statute to consider the environmental, social, and governance factors in the investments that we make, which I think gives us some great cover to do some good work.
Hi, everyone. I'm Sonal Mahida with the PRI. I'm Senior Network Consultant there. PRI is a network of about 1,400 signatories. They're either investors or they are part of the investment community. Together, they manage about 59 trillion assets under management. Obviously, there's a little bit of double counting there. And all of our signatories have signed up to 6 principles that guide best practices in this area. Those principles are non-prescriptive to a certain extent and make sure that there's a various number of strategies that can be addressed. I think earlier we were talking about, uniformity and non-uniformity. There's a lot of different ways to do this in the space. I'm sure we're going to talk about that shortly. What we do at the Principles for Responsible Investment is we provide a lot of best practices, a lot of case studies. I'm going to point out some of my colleagues up there. Natasha works on our private equity work. So she works with the steering committee to look at what needs to be put out into the private equity space to encourage further adaption, what tools are necessary. All of our signatories report to us, which is something I'll talk about a little bit later, and that most of that report is public. And part of the reporting is this to essentially get to the point of accountability. Alex is up there, and he's on our reporting and assessment team. And then over on the end is John, and he works in our U.S. office. So just pointing them out in case I can't answer some of your questions, I may call upon them.
That's great.
And we are signatories.
Yes, and sorry.
As are we. We are too.
Great. Yeah, so I'm going to encourage this to be as dynamic a conversation as we can have, and I'll start by asking each of the panelists at least one question, but after that I want to see what questions you guys have for the panelists. So Ira, there's been a lot of talk and emphasis on impact investing. JP Morgan's done annual reports on this. I think a year or so ago it was about $50 billion, and I think the most recent one was about $60 billion. And while we see reports talking about 21 trillion or whatever the trillions are that are looking at sustainability in some way, one would think that we need to scale impact investing into being at least $1 trillion of dedicated, proactive, specific investments for it to really have a meaningful effect. So if you could talk to how do we scale that, or is that the right question?
Well, I guess I'll maybe frame it. I come from a venture asset class, so when we talk about the $56 trillion of the capital markets, the venture asset class, by definition, is a very, very small fraction of that. But the interesting thing about venture capital is actually the leverage you get from the venture dollars. So venture is about 0.2% of the capital markets, yet venture-backed companies account for about 21% of job creation in the U.S., accounts for about 18% of GDP. So the idea, at least from my perspective on where at least where we can have an impact, it's not by scaling the venture asset class or even the impact side of the venture asset class to the trillions. It's actually the multiplier effect of the underlying companies that we invest in. So let me start with that framework. But in the ventures, when I think about why is impact investing experiencing just an extraordinary time right now, I think of it from the lens of a VC starts with the entrepreneur. We are only as good as the entrepreneurs we back, and the trends that we are investing in are only a function of the entrepreneurs that are leading those trends. So when we look at the entrepreneur side of this equation, what we're seeing is, again, just some of the best and brightest who a decade ago were focused on other things. Today, they want their next chapter not to be divorced from how they're going to make money, from how they're going to live their lives and what passions they have. So I look at a guy like Elon. He was doing PayPal about 15 years ago. Today, his entire focus is on combining the notion of mission and a purpose-driven approach. I look at Lyndon. He was running an enterprise software company, CEO of Solar City. Running an enterprise software company about 15 years ago, sold to Dell. When he was thinking about his next chapter, it was all about impact and mission alignment and a purpose-driven approach. I look at Tom Siebel, whose name is synonymous with enterprise software. Could have chose anything for his next chapter after Oracle and Siebel Systems. He's today running C3 as the chairman and CEO of a company focused on the convergence of energy and big data. The list goes on. Tony Fadell, who founded Nest, father of the iPod, decided to focus his efforts in this area. And so it's being led by some of the great entrepreneurs and executives of our time who are focused on this space. Then I come to a place like I do this morning and see where the next generation of best and brightest are focused. And we do a lot of time, we spend a lot of our time at universities. And the radical change from when I made my first investment in energy 18 years ago to today is transformational in terms of how you all are thinking about where you want to spend your time. So from the entrepreneurial side, it's a renaissance time. It's exciting, and it's what drives our investments. Then I look at the corporates. Again, when I started in this area, it was a lot of greenwashing. I used to get excited when corporates would call and come and trying to have conversations about the portfolio, and very quickly it was obvious that what they wanted to do was essentially get some PR boost and not really drive top and bottom line. Fast forward, we have companies like Walmart creating its entire supply chain where it didn't just have a profound impact on the environment, but actually did have profound financial returns for them, paving the way for so many other corporates right now focused on the space. And now our underlying portfolio has massive interaction with Fortune 1000 as investors, as partners, as biz dev, and again, for underlying startups. That's such a key transformational change that the IT and life science sector has always had, but our energy and sustainability and impact side hasn't. So what does that mean for funds like us? It means that instead of, to your point, being a negative, it's turned into a positive. I always think of, instead of being defensive that we're doing this, this is offensive. This is all about having a competitive differentiation, because folks like Elon, Lyndon, Tony, and the like don't want to work with venture capitalists who are not mission aligned with them. Understand that purpose-driven approach and weaving it into the very nature and the DNA of how we're going to interact actually enables them to achieve their vision and is not at odds. And so for impact investors, it becomes core to actually competing for deals now, as opposed to being apologetic. Then I look at Deborah and so many of the other LPs and advisors who today are talking about this and are committing to this, which really gets to the larger side of the capital markets, much more so than what the size fund. We just raised what I guess people are describing as the largest venture fund focused on impact. It's a $400 million fund, so we're not going to have a big dent into your numbers. But Deborah and some of the larger LPs and advisors today are having an unprecedented focus. You do look at what BlackRock and Bain and Morgan Stanley and Goldman Sachs are doing. These are large institutions that when we started getting involved in this, the words impact didn't tend to come out of their mouths, but today have massive programs. And then the advisors, we work with some of the largest advisors, Cambridge, Mercer, Abbott Downing. We're big supporters of our new fund. And again, historically, that just wasn't where you saw commitments. We did have historically folks like Calvert who've been great supporters in this area, and now I think that some of the other institutions I mentioned are following suit with the vision that Calvert and others had initially.
Yeah, if I could ask a quick follow-up question
No.
before we move on to the other panels. I took a look the other day, and Tesla was up 866% over the last 5 years, which is slightly after they went public, and you guys obviously were an investor before that. So maybe if you could talk a bit about how you guys came to see the vision of Tesla, and when you joined up, and how that's played out.
So in the early days, having been focused on this space for a very long time, by the time I saw Tesla, I'd probably looked at almost every potential electric vehicle innovation technology idea that was out there. And Tesla's innovation was actually finding an off-the-shelf 18650 battery that no one ever thought you could actually apply to a vehicle. But Elon and the team's notion was, if you could actually take the off-the-shelf manufacturing, create a thermal management and powertrain system around it, you could actually decrease costs and finally get to a cost per kilowatt hour that was radically different than what the large OEMs could do. That idea, although it trips off the tongue now, was as contrarian as you can imagine, and my friends called it crazy. Most people had different adjectives to use for the investment. There hadn't been a U.S. auto OEM IPO in over 50 years. Conventional wisdom was, how could a venture capitalist invest in a car company? We actually had incredibly challenging times. I mean, we had near-death experiences in those probably first 4 or 5 years, more than almost any other company I've been involved with. And we literally got 2 times within probably a week of hitting the wall. I give tremendous respect. I have tremendous respect for that team, the tenacity and resolve and commitment that they had to fortitude to stay that course. And I do think it has to do with what underlies the impact movement. It has to do with, instead of being mercenary, this really was missionary. This was a team that just had a vision, and they were not going to let it die. You compare it to some of the companies like Coda and Fisker and some of the others that I really do. I mean, knowing those teams well, I will say I think there was a lot more mercenary aspect compared to the culture and DNA of that Tesla team. Beyond that, I think so much of what has enabled the appreciation has been an aspirational vision and just continuous innovation. I mean, the 18650 idea was an initial one, but there's been, literally the Moore's Law innovation applied to vehicles for an industry that has been a desert of innovation has meant that there's been tremendous opportunity. The stock went public at $17. It's about 200 and change today. It's been one of the largest post-IPO increases. It does, I think, highlight, as does Solar City, that this is not about just doing great things for the environment, but it's also about generating massive financial return. And I think it's a good example of what we're all trying to do on the impact side.
Great, thanks for that. So from a slightly different perspective, then we have the asset owners and what their dealing with and, the choices that they can make in the environment that they operate in. For example, the state of Connecticut will have people who are retired who have all sorts of diverse opinions about climate change. So how does the state navigate that? And then also, perhaps you guys have seen the work of CalPERS. They've took time to construct investment beliefs that not only recognize the fiduciary duty of the need to pay their current beneficiaries, but also the need to pay future beneficiaries. So, Deborah, if you could talk to that a bit.
Well, I think one of the biggest challenge that we have is paying out future benefit payments for retirees that are living longer and longer and longer, which is good for them. Makes it challenging for investment management. But so, essentially, we are engaged in asset liability management. That's what we're about. And I think that distinguishes us from university endowments, for example, that, that invest money so that they can pay out in financial aid, they can build new buildings, et cetera, et cetera. We have obligations well into the future, and we have to make sure that our investment returns are sufficient to meet those future obligations. And that's a very difficult thing, especially in this day and age where returns from the capital markets are much lower than they've been in the past. But I would credit our state treasurer, Denise Napier, for codifying the incorporation of environmental considerations into our investment management decision making. So it's in our statutes. We have to do it. And we have to do it no matter who our state treasurer is. We have to do it no matter who our beneficiary is. And I think that's probably the strongest statement. So with all due respect to the state of California, I'm a California native, so I love California. I think the statute is much stronger than a belief statement. We are also a principal fiduciary state, which means our board is in an advisory capacity. And so principal fiduciary is the state treasurer. State treasurers will come and go. The fact that we've been able to build it into law, I think, gives it some staying power. Yeah. And, we have a very strong engagement practice. We serve on the Series board. We are signatories to UNPRI. Our treasurer was one of the co-founders of the Investor Network on Climate Risk, and also co-convened the first UN summit for addressing climate change. And so it's also, Connecticut is, relative to the rest of the country, a good state to be looking at these politically. Is the climate, no pun intended, tends to be pretty favorable. So.
Right. Thanks for that. And Sonal, the work of the PRI, I've had the benefit myself of doing a little bit of work with the PRI this year on climate change asset owner strategy. So watch this space for a report that we've been promising. But it's interesting to see the growth of the PRI since its origins now about 10 years ago, when there was something like $5 trillion of initial signatories, and we've gone to, I guess it's about 60 trillion. Forget about the double counting, but it's still a very significant percentage of assets under management. So a lot of that success has been in Europe, and now, of course, Sonal, you've been helping drive the growth in the US, and the PRI is now focused on Asia, up to its annual meeting in Singapore next year. So if you could talk a little about how is that going, the growth in other markets?
In the U.S. as well as other markets. So in the U.S., as Carrie mentioned, it, to be quite frank, for a number of years was really driven by interest out of Europe. It was hard to respond to an RFP unless you were involved with the principles of responsible investment or could show that you were addressing ESG issues. And if I can just take a step back and explain kind of where that came from. When PRI was first formed, it was formed by a number of asset owners who had a lot of concern about what they saw as short-termism on behalf of their investment managers. As Deborah was mentioning, a lot of these asset owners, especially pension funds, are looking at a much longer-term horizon, whereas they were seeing that their investment managers were looking at quarterly returns. Well, what gets left off the table when you're looking at quarterly returns versus over 30 or 40 years? A lot of these ESG issues and the impacts that they have to an investment. If you're looking at a corporation, it's bottom line, it's operations. I'm sure you guys are all learning this in your classes, and how that trickles out to investment performance. So in Europe, this has really been taken on kind of wholeheartedly. In the US, we're seeing much more growth and much more of an understanding about this space over the past couple of years. PRI grew 25% last year in terms of the number of signatories that we had on board. And we're seeing, as you mentioned, a lot of more traditional players that you didn't see in the space coming into the space. And to pick up on one thing that was mentioned before, going from the negative to the positive, you are seeing a lot of what we used to call the SRIs. They're not, I wouldn't call them SRIs anymore. They've gone from values-based investing to value-based investing. They, having done this for decades, to be honest, have quite a thorough understanding of how ESG factors play out in an economic context. And if you talk to a lot of them now, they're negative screening, but that's 1994, if that. Now we're looking at integration, and we've moved a lot forward. So that's my perspective on the U.S. We recently expanded into Asia. We've merged with Azria, which is out there. And sorry, I'm going to look at my notes because I don't work on China or Singapore that much, so I had to have a chat with them. But right now we're looking at our strategy in the field out there. We're just starting to roll out, and we're currently defining the strategy. Each and every market is very different when it comes to investing, period. And then you put the overlay of ESG factors out there, and you're starting to bring in cultural perspectives. So as an organization that's global, you really have to have an understanding of how things play out in that market. I'm sure my lending colleagues can tell you they sometimes get an earful from me saying, oh, that makes sense in Europe, that might make sense in London. That's not how it works here. This is not how the field is developed here. These are not the issues that are at the forefront of how people are thinking. So we're looking at that market right now and defining our strategy and how to grow it over there. One example is right now, green finance is a core theme over there and is really quite big, especially in China and some of the developments over there. Did I get to all of your points, Carrie?
Yeah, you also said you wanted to talk a bit about reporting. Was that later today, or you were hoping to do that on the panel?
When we talk about tools and resources, are we going to get to that? I'll just mention it quickly for the students in the room if that's really helpful. If you want to have an understanding what a firm is doing in this space and in terms of your research or any of your academic work, as I mentioned, each signatory has a report that is up online that you can go and have a look at, and it'll help you understand how they define their approach. And there's a common set of questions, so I'm not going to say it by any means it's a comparable standard, but it does give you insight across a sector.
Yeah, I just want to add, why is it that we've seen so many mainstream investors actually migrate into the space? And you only have to look as far as what the portfolio of coal stocks have done in the past few years. And so for so many traditional managers that had coal stocks and in essence didn't leave coal early enough, they saw literally somewhere between 80 to 100% declines depending on which of those stocks they've been in. And when we think about the opportunity here, this is now becoming, the way we think of the world in terms of double bottom line is, it's not just about helping the environment. It actually is why these financial managers are realizing that as you see the cost declines in renewable, you're seeing areas of the world where actually renewables are not at cost parity, they're at cost superiority. And then you're seeing the job creation. Right now, there's a massive inflection point this year. There's more solar jobs in the U.S. than there are coal jobs. I mean, for literally the century where we described ourselves as the Saudi Arabia of coal, that world has changed. And we think of energy as just being yet another cycle of innovation. And like any innovation, if you realize the innovation's happening too late, you miss the massive opportunity on both the investor and entrepreneurial side.
Can I add? I think that there's another driver I'm seeing, not everywhere, but one of the drivers is, and this applies, I think, to a lot of people in the role, an understanding with the newer generation of how these issues play out. I really don't have to explain why ESG factors have business implications more than once to an analyst, to be honest, who's about 25 years old. This might get me in trouble, but portfolio managers who are in their late 50s, early 60s, it is a different conversation. It is a much longer conversation. And I think part of that is also we're going through kind of the intergenerational transfer of wealth, which is also, I think, driving an interest in this area. But I think there's just a better I call it the dolphin tuna generation, is kind of getting into certain roles now and understands how these things kind of can play out.
So we just need to give the millennials more money. That's the answer. So we have a very diverse panel, and you guys are going to be part of this transformation. So are there any questions that have come to mind? I would like to get this into an interactive dialogue.
Deborah, you used the words asset liability management as if it was just a small thing, but as you know, it's probably one of the biggest problems in finance. So So the way, when you talk to other people, you say, you have to pay the checks every month.
Right.
And then you've got a 24-year-old teacher who's just starting his or her career, and the money has to be there in 30 years.
Right.
So you've got all external managers. How do you work with them? What do you tell them? How do you actually manage not only multiples of them, but what are you telling them to allow you to kind of achieve those goals?
Within the context of impact investing, or?
Not overall, because you've got your environmental things that are in statute, you have your financial and asset liability management. That's a balancing act
Right.
for them.
Right.
What kind of direction do you give them? How do you focus it? Do you try to maybe put some of it in one part of the portfolio, or do you have everybody in the portfolio thinking about both things?
Thinking about long-term and, yeah.
Long-term, short-term results, environmental, all things.
We tend not to reach out to our managers on those issues, so we look at asset liability management internally in terms of asset allocation. So, we have a big private investment program. Those are long-tailed investments. They're not very liquid, and we balance those with more liquid investments, equities, and fixed income. And so we take care of that management in our asset allocation strategy and our investment policy statement, and we have actuaries that help align our assumed rate of return with what our capital market assumptions are. And then we go out and we hire managers that we feel can achieve what we are looking for in each of those specific asset classes. And that might include an allocation. We were early investors in renewable energy, but that was really because those investments met the rate of return requirement that we were looking for in that private investment. Actually, it was in venture capital area. And so we do not expect, our managers are experts in picking stocks, in structuring distressed credit portfolios. We don't want to welcome them into the brain damage of making benefit payments. We have them do what they do best, and we try our best to do what we do best. I don't know if that answers your question.
And then how do you know that they're fulfilling the other mandates that you have?
In terms of ESG, we have annual ESG disclosure requirements in our manager reviews. So when we do manager due diligence, we consider a variety of factors, including organizational stability, past track record, all the traditional things that any investor would look at when allocating capital. In addition to that, we have all of the compliance requirements and disclosures. We are a public agency, and so reputational risk is everything to us. Everything we do shows up in the Hartford Courant. And so we also have then an annual ESG disclosure requirement. So not only do we do it at the point of due diligence, and there have been times where when we have 3 equally qualified finalists, that ESG document will make the difference between who gets selected and who doesn't. That happens regularly. When we have managers that don't fill it out and think, oh, this is just the Appendix D that I have to fill out in this RFP that's this long, that tells us something about their cultural commitment to these. And then we expect our managers on an annual basis to reaffirm their approach.
Yeah. There was another question there.
So thank you guys for coming. This question is specifically for Ira. When you look at...
Excuse me, would you mind just using the mic? Because some people in the back.
You have to press the button.
Yeah, sure. So I have to hold it down. This question is for Ira. When you look at specifically the sort of mainstream tech investments, right, and you look at sort of the server use in the background and the infrastructure that takes a lot of water and a lot of energy, that ties directly back to coal. Do you look at that as sort of impact, or look at that as some part of an impact investment when you're looking at mainstream tech companies?
Oh, absolutely. We actually have an investment directly in that space. And actually, if you added up the data center energy consumption and aggregated it worldwide and then mapped it by country, the data center would actually be the 4th largest country on the planet. So, and that's and the energy consumption. Obviously, the trajectory for that is increasing more so than any country's energy consumption rate of growth. So, absolutely, it's an incredibly important area to focus on. We currently have an investment that's focused on that area. In our particular case, the balance that we try and do, and it probably fits this notion of double bottom line, is there's been plenty of investments we've seen that have simply targeted the energy consumption portion, but they've been solutions that actually curtailed some of the value prop you need to actually run a data center, some of the rates and speeds that you need. And then we have a whole set of other investments that we've been pitched, which actually are entirely focused on changing the data rate. And ultimately, we passed on all those until we found a company that combined both. And this company is extraordinary just from a performance perspective, but it actually decreases energy consumption by our estimate is somewhere around 25%. If it actually achieves that in scale, and right now they have relationships with about the top 10 data center customers on the planet, that can have massive energy implication.
A question to Ira. Thinking about divestment and reinvestment, do you think that the opportunity set for reinvestment will provide equivalent risk return? Because presumably the opportunities that you're going to see are going to be a lot more early stage, more venture, as you pointed out, but they will not meet the fiduciary risk return obligations that pension funds have. So the question is, when you're talking to your pension fund investors, are they telling you, well, if we replace, get out of what is a very stable stock into what would be impact, are you seeing resistance?
So did everyone hear that? So actually, we look at it actually with an entirely opposite lens than the framing of the question. We look at it at not that, well, how do we have to compromise a return profile or compromise a risk return profile by focusing on this. It would be a little bit like, and there's some great quotes I'll talk about later today when I do my energy discussion. It would be a little bit like the mainframe folks holding on to the mainframe investments too long and not recognizing the PC revolution. It was like when the president of DEC said there will never be a need for a PC in the home. And those who invested, who stayed the course and held on to their mainframe investments had a risk return profile that we don't think matched what ended up being the PC revolution of the next several decades. We're in the exact same period of time right now. When our limited partners look to us to invest, they're not saying, it's fantastic what environmental benefits you're doing, thank you for doing that, what sort of compromise should we expect on your return profile? What they're investing with us for is because they believe, as we do, that we're in a cycle of innovation that's going to provide massive investment opportunity. And in so doing, of course there's going to be extraordinary benefits on our second bottom line, which is how we combine them. But I think it's a really important question in that I think that really was an old and antiquated framework as to why people were doing this. And the only way we're going to ever achieve Kerry's vision of making a dent in the X trillion-dollar opportunity here is not by compromise. It's not by trade-off. It's actually by delivering better than market returns in this area that creates a second bottom line opportunity.
I would add, if I can add to that, there's definitely the opportunity side. Normally I have to flip and I have to argue for the opportunity side. But there's also the risk management side that's really key. And if you are a diversified investor, especially if you're a universal or long-term owner and you're owning across a number of different sectors and industries, this is about not just protecting one investment, but protecting your investments overall. We've seen now in the past few years, I was chatting with my old boss and he was saying, every time I need to go for a new example of why this is important, it's sort of upsetting, but also really great that there's one from a couple months ago. So we'll see how Volkswagen plays out, but let's look at what happened with the financial crisis and mortgage-backed securities. That did not just impact one industry, that rippled out across a number of industries. Look at BP and Macondo, what happened. That didn't just impact BP stock, that rippled out. Now, before BP, I think if you'd gone to an investor and said, quantify the downside of this type of event, I don't think anybody would have gotten even close to what those numbers look like. So there's definitely the risk management side. I think the trouble with that is, again, quantifying it and putting it in a box because we don't always know what that is, but I think that's a key part of what this field's trying to do.
If I could add something onto that. So last year we retained an investment consultant to try to assess the climate risk across our entire portfolio. It was a great exercise because, candidly, one of the things that we have seen is a lot of talk and a lot of really nice, beautiful font reports that are very difficult then to translate into investment decision making. And so we engaged in this process that was very painstaking. It was probably one of the most intricate and robust analysis I have seen to try to quantify and also to look at where the climate risk in our portfolio was. But now the challenge is, so what do we do about it? And when you think about mitigating climate risk in the portfolio, the choices you make to mitigate could create new types of risk. And so there's no plug-and-play solution for balancing risk management, and that's something that we struggle with, and that's something we would really like to see out of the industry, are tools to help us we know what our portfolio has exposure to. There's less of a universal understanding of the best ways to deal with it.
I'll just say it
There's
quickly.
a panel later today on.
I'll just say quickly in terms of risk that, when you think about our energy risk, the lights powering these rooms are being powered by the oldest electrical machine in the world. The grid hasn't changed in 100 years. I would say if Edison woke up, he'd actually unfortunately recognize our grid. And essentially we've been single tracked. If you were part of any of the blackouts or brownouts over the last few years, you realize what kind of risk actually to business that presents. You probably remember the Super Bowl had a blackout. I mean, we're in a world right now where the pressures on our grid right now demand us to find risk mitigation tools in the form of we talked about microgrids, earlier it was referenced, but there has to be new forms of dealing with, and the grid is just one example of the extraordinary weather events that have really pummeled so many areas of the world and caused massive, massive economic loss. And in finding new tools and innovations to actually deal with the fact that we've really had an energy infrastructure that's as vulnerable as it is, I think that's an element of risk mitigation that probably doesn't get as much attention in some of the analysis. But as we're going to see over the next decade, I think some of the innovations and some of the ways, economic opportunities, investment opportunities to deal with that are going to be incredibly important.
Just one follow-up question. So there's an opportunity set and there's concern over climate risk. Is that getting reflected in the asset allocation for pension funds like you already or not there?
Well, there's different, there's embedded climate risk in every sub-asset class within asset allocation. One of the conundrums for a public pension fund is that we don't like to overpay for managers. Expense management is very key to us. We don't want to use our pensioners' dollars to be paying exorbitant fees. And we're not alone in that regard. And so what that lends us toward is indexing in areas like U.S. public equities. We index a lot of our U.S. public equities. Why? It's cheap. And if you look at it, the returns that active managers in U.S. equities have been able to generate have not been good enough to justify their fees. So then that makes us difficult to incorporate any sort of climate analysis into our U.S. And then we have active managements in small caps and other areas where we feel managers can add value. So in dealing with issues around climate and other environmental issues and how to mitigate those in the portfolio, they also have to make sense for us in terms of expense management, because we look at fees very, very carefully, and we have not found a U.S. equity climate-sensitive portfolio that we believe on a net of fee basis is better than what we have in our index fund.
So hopefully the students will create some
Yeah.
new ideas for you.
Hi, everyone. Thanks so much for your insights. We talked a little bit about scaling today, and in particular, when we talk about scaling and impact of environmental and social issues around the world, a lot of that piece is in the nonprofit sector. And I wonder if, for those organizations or initiatives that don't make a profit, how do you see that fitting into the investment space as well?
We have some companies that don't make a profit, but this is unintentional.
I only say because I'm in an interesting class right now on impact investing. We talk about new models for equity capital in nonprofits and new fundraising models and new hybrid for-profit nonprofit institutions. And I wonder if you have any insights in that space.
Well, I mean, the traditional nonprofit players in this space, ourselves, Series, US SIF, we've mainly been there to support the industry and to educate the industry and provide tools and provide collaborative opportunities and platforms for them. So that's traditionally what has happened to date. Doesn't mean that there can't be other innovative models out there for this space, but it's really addressing that big need of trying to. ESG is not the only thing that a lot of these investors are looking at. So making sure that they've got the right tools to make it as efficient for them as possible to look at this.
This is part of a trend of many different things that are playing out kind of as we speak. So in addition to sort of new business models, we're seeing Goldman Sachs committing $150 billion to renewable energy investments by 2025. I would encourage you to seek out the 2-minute video of Lloyd Blankfein talking about this. It sort of tells you that the game has changed, because 2 years ago he was saying something very different. And you have APG, the large Dutch pension fund, committing now 50 billion euro to positive sustainable investments, and also deciding to completely redo their entire portfolio. So getting away from this idea of universal ownership. Very interesting trends. Generation's been around for 10 years, and they've actually beaten their benchmarks, unlike most active managers who do not. So there's a lot of interesting trends underway, and that, I think, is part of it, is this idea of new business models.
If I can just add one, because I think it's relevant since we're at a university. University of California, both University of California and Harvard have committed to funding climate change solutions. I believe University of California was $1 billion, almost 1% of their endowment.
Can I just quickly add one thing? Because clearly we focus a lot, and we have been talking a lot about the energy and environmental side. But I will say that impact is a lot broader than that. And one of the important metrics and focus areas for us is diversity. We just think our companies make better decisions with a diverse executive team and overall team. And it turns out that actually, rather than that being, again, to the point of compromise, by having that focus, we've been able to attract some extraordinary entrepreneurs that I think other firms just wouldn't have had the same opportunity to invest in. Turns out 4 of our first 5 investments in this new fund have been women-led. And that wasn't because we set out to design it. It's just because of a cultural way we approach our investments. And again, venture capital is all about finding competitive differentiation relative to the other capital in the asset class. And I think it's just yet another example of, rather than being defensive, rather than being apologetic, rather than being negative, we think we're building an extraordinary opportunity by having an impact focus where there's a number of things beyond environment, diversity being yet another one, that enables us to build a return profile on the financial side that is turning out to be terrific and not about the compromise.
If I can add to that, that's also been reflected in the public equity side. There's been a number of studies that have come out, and they've had different angles and different conclusions. One was if you had a certain number of women on your board, you were less likely to have a corporate scandal. Others looked at performance, but what they found was there's definitely no downside, and there's quite a bit of potential for upside for a company's board of directors to increase their management and increase their performance the more diverse they are, which just shouldn't be surprising.
It's been an important critique of the venture asset class in particular, that there just hasn't been enough diversity within the asset class. I think we're fortunate that we actually have, our firm itself is diverse, and then I think that lends itself to finding portfolio companies that are.
And I would add that the state of Connecticut has what's called the Connecticut Horizon Fund program, which is all geared toward investing in women-owned, minority-owned, Connecticut-based, because we're Connecticut, and opportunistic or new, funky, emerging types of managers. And that's a very key, and we have rolled that out in our public equity space, our debt, in hedge funds, and now also in private investments. And so seeking those types of Fairview for venture capital. And that, I think, has really helped us find new entrepreneurs that traditionally don't have access to large pools of capital.
Deborah, how do you reconcile your own belief that active management adds little value with Yale's, a university that you teach for, belief that active management does add value?
I think active management adds value in some areas. I think in large cap U.S. S&P 500, not quite as much. We have a passive mandate in U.S. large cap, but our U.S. small cap is active. And so we are mostly active, with the exception, I would say, of sort of the traditional S&P. And then we have a little bit of an enhancement around the margin. So we're really looking at sort of net of fee competitive rates of return. But we also have, in our Horizon Fund program, we also have dabbled in a couple of large cap U.S. equity managers, but they have sort of a unique strategy. I don't think, is active management or passive management the right way or the wrong way to go? I think you could defend either choice. I know that sounds sort of cynical, but we have chosen passive and U.S. large cap.
Follow that. Do you have new managers that are advocating for active ESG management techniques?
Interestingly, we have not seen a lot of managers reaching out to us on ESG specific mandates. One of the things that we have sought is figuring out how we would benchmark all of our managers. And we've looked at, and so we are in the stage right now in terms of looking at different ESG-related indices, how they compare to traditional indices. Should we be looking at managers against the ESG indices or against both, and how do we do that? Until recently, candidly, the ESG benchmarks haven't been that good. They've been okay, but we have a big public audience that we have to be accountable to. I think MSCI is here today. They have quite a good deck of benchmarks, and we've looked at those, but we're still mulling it about now at this point.
There was a question in the back.
Hi there. I was wondering, as a lot of the new larger financial institutions are launching new funds with impact strategies, as they figure out their impact strategy, do you see either risks as there's a flood of new capital to this space, whether there's bubbles or misallocations to certain innovations, or conversely, do you have hope about certain areas of innovation that will really get scaled as there's new funds and new eyes on this space?
I love the question because the notion that we're somehow going to have too much capital and impact is a relatively new concept for our space. I think we'd be fortunate to be in that position. And I think if you just take, at least from our perspective on the innovation cycle side, again, I'll talk about it later, but we think we're literally in the first inning of the first game, of a first season, of a first century of games that are going to be played to overhaul our 21st century energy economy. Our fund focuses a lot broader on other areas of impact. We have multiple investments in geo and space that are going to give new kind of imagery and tracking that enable all kinds of impact benefits as well as great financial returns. There's so many just different areas of opportunity that right now we're seeing the opposite. We're seeing, if anything, there's an imbalance of supply and demand of capital relative to the opportunity. And so on a market, entrepreneurial, on all the dimensions we would analyze as venture capitalists, things are looking great. One of the things we have to focus on is financing risk, because this is a relatively still contrarian view in our asset class. And so when we're looking to capitalize our companies, we're trying to find as many like-minded investors to actually ensure that we get through the cycles that inevitably a startup has.
One more question. Anyone? I'll ask a question if there isn't. Oh, there's one in the back.
There is a workshop later on use of metrics with ESG investing, and Todd Court at the conference last week posed the question, is there enough data for investors? Do you find there is enough data in your DDQ process? And you mentioned the MSCI has a good deck. Is that a misperception that there is not enough data and metrics?
Well, I'm not sure the context in which the statement was made. Disclosure is low, but if you ask for it, you can generally get it. So I don't know if I can say across the industry data availability is good or bad. I think the challenge for us is the methodology used to construct the metrics. How I define it and how fellow panelists and the audience members define it is very different, and we don't have a universal acceptance on what that is. And so you have a lot of heterogeneity in methodologies, and that makes it very difficult for us as kind of big, boring investors to try to pick one defensively. If I had to guess, I would say there's probably more data available than people perceive. It's just nobody's really been asking for it. And that's sort of also a cynical response. But
I would just also add, I think SASB's here and speaking later, but I think we're going to see improvement in the data and the quality and quantity of data that's out there as SASB kind of takes up on traction.
Isn't there a hidden challenge of data beyond public companies, though?
Well, we have an entirely metrics-driven approach. We actually produce a Bible for our LPs every year that goes through an extraordinary, excruciating detail on metrics that we track with every one of our portfolio companies. We track trend analysis with that. We do everything from, of course, the environmental set of metrics, but we also have diversity, job creation, economic development metrics that we track. So it's across a set of extraordinary detail. Yes, it is, but we do go into a lot of detail, and it is not superficial. It is actually not an Exhibit D to how we operate. We also have someone full-time on our team We all do it as investors with each of our portfolio companies. We actually work with each of our CEOs and executive teams on second bottom line in addition to our ordinary roles as board members. But we also have an additional resource on our team where literally morning, noon, and night, that is all that's focused on, is how we integrate second bottom line principles into the portfolio. I'd also be remiss to say we are hiring. I don't know if Nancy mentioned it last week, but I promised her I would mention it here today.
The line starts.
Which of course has nothing to do with the metrics answer, but I didn't weave it into any other part of my answer.
So there's an interesting dynamic here of the asset owners who work with the fund managers who then can gather the data from companies in different asset classes, and then you have the PRI encouraging better practice. I like this dynamic. I don't know about you guys. Do we have time for maybe one quick further question in the back?
What has been your relationship with the Global Impact Investing Network and the IRIS metrics that they've created? Have you used them?
Is that for you?
Yeah.
That's for you, I think.
Yes.
Yeah, there's yes, and it's one of a number of examples of inputs. I mean, I think that Deborah said it well. There's a set of metrics, non-uniform, but there's a convergence of things that we use to ultimately create a template that we found works well for underlying startups. It's not excruciating at all.
But maybe in conclusion, it's fair to say there's still a long way to go. The GIN work only covers that sort of 60 billion impact space. It doesn't cover this larger $450 trillion of global assets that we're dealing with. So, you know, Francis was talking about this need for a clean $1 trillion a year of new investment in the low carbon future economy. You know, where that money will come from is a question. There's a lot of questions, but there's a need for better products. So hopefully the rest of this conference will give us some better ideas. So I think we have to wrap up here. So thanks for having us.
Thank you.